AI market over the last couple of years has been, well, nothing short of a euphoria engine.
Oh, absolutely.
We've watched the S&P 500 climb, what, 75% since late 2022?
Yeah.
And it's largely been towed along by this promise of exponential AI productivity.
It's been intoxicating.
It really has. But let's be honest, the recent market action, I'm thinking those early November weeks especially, it felt less like a smooth flight into the stratosphere and more like the financial equivalent of some really heavy, unexpected turbulence.
Turbulence, yes, and I think a necessary reality check. The concentrated nature of this rally meant that when that air pocket hit, the drop was, well, it was violent.
It was.
I mean, we saw the Magnificent Seven collectively erase $1 trillion in market value within just a few trading days in early November.
$1 trillion. It's just an insane number.
That kind of sharp synchronized decline shows you exactly how fragile valuations get when they're driven purely by narrative and future potential rather than by, verified high-velocity cash conversion today.
Exactly. And that's the core tension we are researching in detail today, isn't it? It's this clash between the market's currently priced-in reality, what we're calling the AI utopia,
right,
and the cold, hard data that's pointing towards a much slower, much more grounded financial reality.
Mm-hmm.
So if you are tracking insider signals, you need to know which of those two visions the people who run these multi-trillion-dollar businesses are actually betting their personal wealth on.
And that's our mission here. To cut through all the hype and just extract the raw intelligence, our audience already gets the mechanics of insider tracking, the Form 4s, the 13Fs.
They know the game.
They know the game. So we are here to get into the weeds of the data. We need to know who specifically is selling their stock, who is making these massive directional shorts, and what those insider and whale signals tell us about the longevity of these valuations.
And we have assembled some truly incredible financial intelligence. We're going to cover the return of Michael Burry, whose billion-dollar short position is underpinned by this very technical and frankly brilliant critique of corporate accounting.
It's fascinating stuff.
We'll also track the CEO cash-out club that sold aggressively right into that recent volatility. And we'll look at why a classic M&A accounting trick, the way GPUs are depreciated, might be wildly inflating tech earnings right now. We have to separate the enduring productivity gains that justify an investment from the, transient speculation that justifies a short.
What's fascinating here is the market isn't necessarily panicking. I think it's restructuring its expectations. For years, capital allocation has been subsidized by the utopian promise.
Right.
Now investors are demanding evidence. The market wants a detailed syllabus for turning that $1 trillion of infrastructure spend into auditable, resilient cash flow. We are really witnessing the separation of substance from the story, and the smart money is moving its capital accordingly.
Okay, so let's start with that valuation extreme. The enthusiasm has driven the market into what some very sophisticated analysts have dubbed the perfection regime. When we were doing M&A diligence, we always factored in a risk premium, but here it's like the risk premium has been inverted.
It has. The perfection regime basically means investors have already priced in the absolute best-case scenario AGI delivered by next quarter, exponential productivity gains hitting the P&Ls immediately, universal, frictionless adoption.
So the future has already been capitalized into the present stock price.
Completely. And that means there is zero margin for error.
A heroic set of assumptions indeed. Because that perfection regime, it requires immaculate execution, perpetually expanding margins, deep competitive moats, and crucially, frictionless adoption.
And nothing in enterprise technology is frictionless.
As we both know from chasing endless integration documents, right?
Precisely. And if any one of those heroic assumptions fails, if adoption is slow, or if margins contract because of competition, or if the hardware refresh cycle costs more than expected, then the entire current valuation structure just collapses because that long-duration growth is suddenly priced incorrectly.
And the most probable outcome that analysts are identifying isn't a collapse, but something much more mundane, slower. They call it the integrative scenario.
The integrative scenario suggests that AI is transformative, yes, but it solves specific bounded problems, and it does it over a manageable 3 to 5 year horizon.
So we're talking about things like sophisticated transcription or...
Yeah, complex routing and logistics, faster legal discovery, classification, and quality control in manufacturing. It's revolutionary, but it is not superintelligence.
And crucially, it falls short of underpinning a multi-trillion-dollar AGI future on an investable time frame. The companies that benefit most in that scenario aren't necessarily the chip designers or the hyperscalers priced for AGI,
Yeah.
but the specialized software providers and industrial firms who integrate this bounded AI successfully into their deep, sticky workflows.
And this brings us right to the corporate adoption mismatch, which is where that utopian narrative really hits the wall of enterprise reality.
Okay.
I mean, the broad data looks good on the surface. Almost 9 out of 10 organizations are using AI in some function IT, product development, service ops. That shows ubiquity.
But ubiquity doesn't mean conversion, does it?
Mm.
Here's the crucial gap. Almost 2/3 of those organizations report they have not scaled beyond pilots.
Exactly. They're running experiments, they've bought the compute, but they haven't yet achieved the institutional workflow redesign that you need to generate transformation-level, high-impact profit.
I mean, you have to think about the friction there. Scaling AI isn't just about installing software.
Not at all. It requires massive overhauls in data governance, securing regulatory compliance, retraining thousands of employees, and integrating the AI output into core, auditable financial systems. This is change management on an enterprise level.
And that takes years, not months.
Years! And the financial consequence of that lag is devastating for the perfection regime. We see this P&L translation problem emerge. Only a minority of organizations attribute any enterprise-level earnings impact to AI, and most of those estimated under 5% of total earnings.
5% is meaningful on the margin, sure,
Yeah.
but it is completely insufficient to underwrite the multi-trillion-dollar revenue machine that the market is currently demanding.
It's not even close.
If you're paying for 3-year growth based on a 3-year hardware cycle, but the earnings conversion is lagging at 5 years, your entire valuation model is just fundamentally broken.
It's broken.
That's the real strategic imperative shift in capital. You know, when we were evaluating targets in private equity, we always favored firms that could self-fund their growth, that could convert innovation into resilient cash flow.
Well, of course.
The market has been subsidizing utopia in advance, assuming these massive external capital injections. But if those exponential returns don't materialize on the short time frame the stock price implies, the whole valuation structure becomes unstable.
And that capital has to rotate to firms demonstrating discipline and internal funding capacity.
Right.
And we can't talk about unstable structures without discussing the AI supply chain lag this timeline confusion. We've seen nearly $1 trillion deployed into infrastructure, but the returns are just bottlenecked by physical reality. The end-to-end lag from initial lithography decisions to actual measurable GDP impact can span 5 to 15 years.
5 to 15 years is an eternity in trading,
It is.
but it's the reality of hard infrastructure. Break down those timeline specifics for us.
Certainly. So it starts with photolithography, which is dominated by ASML's extreme ultraviolet tools. Those have an order-to-delivery and installation lag of, 1.5 to 3 years? Then you have the chip design cycle, like Nvidia's architectures, which takes another 18 to 36 months to move from a concept to mass production silicon.
And that's before you even have a place to put them, the fabs themselves.
Exactly. Fab construction adds another 3 to 4 years of upfront capital expenditure before the first chip is even baked. And even once the GPU is installed, model training takes months, and then corporate scaling takes another 2 to 5 years just to hit that 5% EBIT impact we just discussed.
This whole sequence explains why the returns are lagging so badly.
It matters immensely when we consider the massive financial hurdle the industry has set for itself. You have roughly $1 trillion invested in infrastructure, a massive capital sink. What kind of returns are required to justify that spend?
Okay, let's run the numbers. If we assume a 5-year useful life for the hardware, which, as we'll get into, is probably optimistic,
Very optimistic.
and we require a target 15% return on invested capital, which is a disciplined target for this scale of infrastructure.
Then the industry needs to generate $150 billion in annual EBIT just to cover the cost of capital and the depreciation.
And if we assume generous 30% EBIT margins for these platform companies, which is a huge assumption given the competition,
Huge.
that $150 billion in required EBIT means the industry needs to generate $500 billion in annual revenue by 2030.
That is the financial geometry required to underwrite the current valuations. To achieve that $500 billion target by 2030, the market needs to grow at a compound annual growth rate, a CAGR that is orders of magnitude faster than historical enterprise IT spending.
And where are the current platform run rates at now?
Oh, they're still in the low tens of billions. The current price action is paying for 500 billion in ubiquity now, even though the actual revenue conversion is an order of magnitude and several years away.
That's the disconnect.
This immense disconnect between the infrastructure cost structure and the revenue geometry is the primary reason the market feels so brittle right now.
And this inherent brittleness is exactly what attracts the smart short sellers. Which brings us to the return of the man who literally wrote the book on profiting when a brittle structure cracks. Michael Burry. He's back, and his signal is loud.
It is. His Q3 2025 13F filing disclosed substantial put options against the two key proxies for AI euphoria: Nvidia, the hardware backbone, and Palantir, the software and government AI specialist.
And this isn't just noise.
No, this is a directional bet on structural skepticism.
The notional values confirm this is a major move, not some small hedge. We're looking at $187 million against Nvidia, the cornerstone of the entire bull market, and a whopping $912 million against Palantir.
It's over $1 billion.
That's over $1 billion betting against the continued AI frenzy, and it's all underpinned by a very specific technical criticism that, honestly, only a forensic accountant would spot.
And this is what makes Burry so dangerous. His core claim is that the hyperscalers, Meta, Alphabet, Oracle, Microsoft, Amazon, are engaging in one of the more common frauds of the modern era by artificially extending the useful life of AI hardware assets, specifically the GPUs.
Okay, let's clarify this accounting controversy because it's key. When a company spends billions on equipment, like a GPU cluster, JAP rules don't let them expense the entire cost immediately.
Right.
They have to spread the cost, they depreciate it, over the asset's estimated useful life.
That's right. And if that estimated useful life is too long, say 5 or 6 years, the annual depreciation expense reported on the income statement is too low.
And lower expenses equal higher reported earnings.
Exactly. This effectively inflates your short-term profits and, subsequently, the PE multiple the market is willing to pay.
And the mechanism Burry describes is perfectly logical in the context of Moore's law. These companies are racking up massive capital expenditure on GPUs that have an economic product cycle of maybe 2 to 3 years. They become obsolete really fast.
Competitively obsolete, yeah.
But they're using accounting schedules that depreciate them over 5 to 6 years, or even longer. That gap between the economic reality and the accounting presentation is the core of his short thesis.
He argues that the rapid pace of innovation, moving from A100 to H100 to Blackwell, means the economic life of these assets is truncated. They have to replace the hardware much sooner to stay competitive, but they are still carrying the original cost on the books for years, pretending it's still generating value.
And the numbers he's throwing out are just staggering. Burry estimates this depreciation gap among the hyperscalers masks the actual economic cost of rapid obsolescence, inflating short-term profits by potentially $176 billion through 2028.
If that $176 billion were suddenly recognized as accelerated depreciation expense, the impact on earnings would be catastrophic. He actually quantified the risk for specific companies.
Right. He singled out Oracle and Meta, claiming their reported earnings will be overstated by, 26.9% and 20.8% respectively by 2028. Why Oracle and Meta specifically?
Well, Oracle, for example, has been really aggressive in its cloud expansion, leveraging its ability to quickly scale data center capacity. If they're aggressively capitalizing this spend and stretching the useful life, their reported non-GAAP profitability looks extremely attractive, justifying their higher stock multiples.
Okay. And Meta.
Meta is investing so heavily in pure compute for its generative AI and Reality Labs ambitions. If that specialized hardware, designed for cutting-edge models, obsoletes in 2 years, but they depreciated over 6, their path to future free cash flow is severely hampered by the need for massive replacement capex that the current P&L isn't warning investors about.
This speaks directly to the financial consequence we mentioned. If the market is valuing these companies based on inflated PE ratios, and the true earnings are actually 20% lower, a 20x multiple instantly becomes a 24x multiple based on the real economic earnings.
Right.
That instantly contracts the stock price without any underlying change in the business. It's a pure financial mechanics short.
But Burry's math, as technical as it does have some strong counterarguments.
It does.
David Friedberg, the former Alphabet executive, challenged this view on the All In podcast, arguing that Burry missed the evolution of data centers and the nature of compute.
Right. Friedberg's point is that modern data centers are processing centers, not storage centers that were dominated by quickly dying hard drives. He cited industry checks showing that older chips, 7 or 8 years old, are still operating at full utilization.
Especially for less intensive generalized workloads like cloud services.
Exactly.
And this evidence supports the decisions by companies like Google, which extended its server life from 3 to 4 years to 5 to 6 years back in 2021. The utility of the chip doesn't necessarily die just because a faster one exists. If they can sell the utilization for 6 years, then the longer depreciation schedule is financially justified.
And then there's the other counter-thesis, that faster obsolescence is actually a feature of the AI boom, not a bug. If chips are dying faster, it just means demand is accelerating because workloads are scaling and migrating to the next generation of power.
Obsolescence equals innovation. Every new Nvidia generation, A100, H100, Blackwell, Rubin, isn't a failure. It's proof that the demand for compute power is growing exponentially.
So in that view, the losers aren't the companies building the infrastructure.
No, it's potentially the companies who bought older chips and now have uncompetitive compute costs.
So Burry's skepticism hinges on the necessity of a faster, forced refresh cycle due to competitive pressure, which leads to these painful write-downs.
Right. And the counter is that the utility of the hardware lasts longer than he assumes, or that the rapid innovation justifies the current capex as a rational, long-term bet on future market dominance. It's a massive intellectual and financial tension right there in the heart of the balance sheet.
And this tension, this whole question of whether the valuations are real or just inflated by accounting, it serves as the perfect bridge to our next section. If the valuation structure is this vulnerable, what are the people closest to the financial statements the insiders doing with their own stock? Do their actions validate Burry's concern?
Let's find out.
Let's move from theoretical shorts to the hard evidence from Form 4 filings. This is where we track what the people who actually run these multi-billion-dollar businesses are doing with their money. And the pattern is, frankly, alarming.
It is a clear, unbalanced equation. Insiders are net sellers, selling aggressively right into the recent volatility. The critical factor here is the absence of countersignals.
That's the key.
We have seen 0 big, intentional open market buys reported across major AI stocks throughout November 2025. This coordinated pattern of net selling with no offsetting confidence buys is a massive signal of de-risking and liquidity preference.
Let's start with C3.ai. This is a pure-play AI company. Their stock performance is entirely predicated on the continued accelerated utopian narrative. Yet their CEO, Thomas Siebel, executed a massive indirect sale of 8.3 million shares on November 11th. Valued at $126 million.
That is the antithesis of confidence. That's not a routine quarterly trim for tax purposes.
Not at all.
That sale occurred right as the market dip intensified, and investors were questioning the stability of the sector. When the founder and head of a company whose future depends entirely on the AI boom liquidates $126 million of his holdings, he is signaling caution about near-term valuations and market structure.
Okay, now moving to the giants. Microsoft is the deepest partner in this story through OpenAI and Azure. They are supposedly the most secure, diversified bet on AI infrastructure. If anyone should be buying the dip, it's their leadership.
You'd think so. Yeah, we see selling activity, though, too. Bradford Smith, the president, sold shares worth nearly $20 million on November 3rd.
$20 million.
And while we often dismiss stock gifts, both Smith and CEO Satya Nadella gave away stock as gifts around November 6th and 10th. These transactions reduced total insider holdings.
The takeaway is the powerful silence, isn't it?
Exactly. Despite the company's massively bullish public posture on AI, the leaders did not buy, but rather chose to reduce their risk exposure.
And that sentiment extends to Meta Platforms, which is pouring tens of billions into CapEx and is so heavily reliant on AI-driven social media plays and that infrastructure build-out. They are the definition of a high beta, high risk AI stock.
And Meta executives have been consistently de-risking. We tracked multiple sales in mid-November totaling over $13 million. This isn't just one person selling, it's coordinated activity.
Who are we talking about?
The COO, Javier Olivan, had multiple sales, including a $1.9 million disposal on November 17th, and the CFO, Susan J. Lai, sold shares worth $4.9 million on November 14th.
The CFO selling is particularly interesting to us given our background.
Mm-hmm.
CFOs have the most immediate and clearest view of cash conversion, CapEx requirements, and the true cost of that GPU depreciation we just discussed.
They're closest to the numbers.
When a CFO of a capital-intensive company like Meta sells into volatility, it tells you they prioritize liquidity over the near-term valuation promise.
Amazon shows a similar pattern. Douglas Harrington, the CEO of Stores, sold $6.1 million on November 3rd. And again, you see gifts. Jeff Bezos and director Jamie Gorelick gave away stock.
Even though AWS powers a massive portion of the AI infrastructure.
Right. The leaders are getting lighter on their positions right when the utopian narrative is strongest.
And even Nvidia, the chip king, the CFO, Colette Kress, executed an indirect sale on November 3rd, valued at nearly $10 million.
9.92 million, yeah.
So when we aggregate all this, $126 million from the CEO of C3.ai, $20 million from Microsoft's president, and significant sales from the CFOs of Nvidia and Meta, the conclusion is just unavoidable.
The people closest to the books, the ones who truly understand the cash conversion lag and the required CapEx geometry, are universally prioritizing de-risking. They are choosing liquidity at elevated prices now, rather than betting their personal wealth on further valuation expansion in the immediate future.
This insider intelligence provides a powerful practical validation of Burry's theoretical skepticism about short-term viability.
It absolutely does.
So now we move from the insiders, who are usually constrained by trading windows, to the institutional whales, the hedge funds, and major investors who can make huge strategic moves based on market structure.
Right. And the Q3 13F filings, which were disclosed mid-November, showed a fascinating strategic reallocation.
The biggest signal, the one that truly fueled the bubble speculation, was the Peter Thiel exit.
Big one.
His fund, Thiel Macro LLC, sold its entire stake in Nvidia, 537,000 shares, valued around $100 million based on Q3 prices. This was a full exit from the consensus cornerstone of the AI boom.
Thiel is legendary for his contrarian timing. He co-founded PayPal, got out before the dot-com crash. He has a proven track record of selling when the narrative peaks and the valuation risk becomes untenable.
So when someone with that history performs a clean break from Nvidia, what does that imply?
It implies he believes the momentum trade has run its course, and the stock is priced for a reality that simply won't materialize on the necessary time frame. It's a signal that the initial wave of easy, momentum-driven alpha is over.
But Thiel wasn't the only massive seller. SoftBank also engaged in significant profit-taking.
Right. They sold $5.83 billion worth of Nvidia shares. That was reported recently, though the planning happened post-Q3. But, and this is a key distinction, they coupled this with a statement saying the proceeds would be moved to other AI investments.
So it's not an exit from the space.
Oh, exactly. SoftBank isn't abandoning AI. They are engaging in classic strategic reallocation. They are taking the premium profits off the most hype name, the most expensive stock in the sector, and rotating that capital into perhaps earlier stage, less valued, or more diversified bets within the AI stack.
The easy 5X has been captured. Now they're hunting for the next 5X somewhere else.
Precisely. And this broader hedge fund trimming reflects that selectivity. It's not an exodus, but a surgical reduction of exposure to the highest multiple names.
Like what?
Coatue Management cut its Nvidia position by 14%, Tiger Global slashed its Meta position by 63%, and Lone Pine reduced Meta by 35%.
Wow, Tiger Global's cut in Meta is huge. A company that relies so heavily on the utopian vision of the metaverse and its massive AI infrastructure.
It signals a serious skepticism about the capital allocation discipline at the very top of those aggressive CapEx spenders. They're dumping tech stocks at the fastest pace in 2 years amid bubble concerns, but the institutional money isn't leaving the ecosystem entirely.
That's the critical nuance, isn't it?
It is. Overall, institutional holdings in AI infrastructure actually rose 30 to 35% in Q3. The money is just reallocating. It's moving from high multiple momentum stocks into diversified foundational players that can actually underwrite this massive shift.
And this brings us to the ultimate contrarian bull signal, which provides the counterweight to all the selling.
Warren Buffett.
Warren Buffett's Berkshire Hathaway. They initiated a massive $4.3 billion position in Alphabet during Q3. Berkshire's investment philosophy is notoriously focused on durable competitive advantages, cash flow stability, substance over hype. What does this massive bet on Alphabet signal about the state of AI investing?
It signals confidence in diversified AI plays that have entrenched distribution and massive non-AI-derived cash flows. Google Cloud, Google Search, DeepMind, these are foundational assets. Buffett favors the platform that makes real auditable money now, not just in the pure hardware or speculative software plays priced for AGI tomorrow. Alphabet is uniquely positioned to fund its massive AI capex internally, which drastically reduces risk compared to a company dependent on perpetual external capital or high stock valuation to justify future spending.
Okay, so the whale activity is telling us three simultaneous critical things. First, the pure momentum trade, symbolized by Nvidia, is being fully exited by historical market timers like Thiel.
Yep. Second, the high beta, high capex AI software plays like Meta are being aggressively trimmed due to valuation concerns and capital allocation risk.
And third, capital is rotating strategically into diversified, cash-generative platforms like Alphabet.
Right. This shows sophisticated investors are moving away from paying scarcity premiums for the promise of AGI and instead accumulating firms that have the financial discipline and the cash flow resilience to survive that 5 to 15-year timeline lag we talked about earlier.
We've established the theoretical risk with Burry, the insider signal with the CEO sales, and the strategic response from the whales. Now, let's widen the lens and look at the systemic risks that could catalyze a broader correction.
Okay.
Starting with the macro environment and this liquidity amplification loop.
Analysts are warning that a potential tilt toward easier U.S. monetary conditions while stocks are near all-time highs risks stimulating a bubble. This configuration is dangerous because historically the Fed eased into weakness.
Now, if the Fed pivots while stocks are already strong, low real yields drive capital into growth equities, expanding PE multiples and inflating long-duration assets, which is precisely where AI stocks sit.
It's like pouring fuel on a fire you're trying to contain.
Exactly.
And this is a crucial modification of the classic Minsky dynamic, the cycle where financial stability breeds instability. In the classic formulation, the crisis starts with excessive debt and leverage.
But that's not what's happening here.
No. Here, the current market excess is fueled less by debt and more by belief. We're calling it narrative capital.
So the trigger for a collapse won't be a classic credit default or balance sheet stress, but rather a sudden, widespread disappointment in adoption timelines.
Exactly. The market is waiting for that promise of productivity to materialize, and time, or the lack of it, is the primary risk factor.
And speaking of narrative stress, we have to address the chaotic communication from OpenAI, which acted as a major market trigger in early November.
That was something.
The spark was Sam Altman's frisky response to investor Brad Gersner about how to justify a mind-boggling $1.4 trillion spending commitment on their infrastructure.
Which immediately tapped into the underlying AI bubble anxiety. And then days later, the CFO's talk of hoping for a government backstop fueled fears of insolvency, triggering a sharp sell-off in Microsoft, Nvidia, and Oracle.
Altman quickly clarified that the request was explicitly not a bailout.
Right, but a call for strategic industrial policy, U.S. reindustrialization across the entire AI stack. But the nature of the request itself is highly revealing of the systemic costs involved.
What specifically is OpenAI asking for under the banner of industrial policy?
They want the government to lean in with investment expanding CHIPS Act-style tax credits beyond just chip manufacturing to cover the entire supply chain.
The whole thing.
The whole thing.
Yeah.
Grid components, advanced cooling systems, data center build-outs. And they want the government to step back by accelerating transmission and energy permitting and cutting red tape for power infrastructure projects.
This points directly back to the infrastructure hurdle. It's not just about chips. It's about the electron gap. The amount of electricity required to power these advanced models is so vast that the current U.S. power grid and regulatory permitting framework just can't support the required build-out velocity.
So they are effectively asking the government to subsidize the lowest return, highest friction part of the entire AI stack, utilities, and infrastructure.
And their justification for this trillion-dollar ask is based on an explosive timeline.
An incredibly aggressive one. OpenAI predicts systems capable of very small discoveries by 2026 and more significant discoveries by 2028.
And how?
Fueled by a jaw-dropping 40x per year decrease in the cost per unit of intelligence. This aggressive near-term timetable is the only thing that justifies the required state intervention and capital expenditure.
But that aggressive timeline clashes directly with the third major risk.
Yeah.
The battle for developer trust, or platform risk.
It does.
Startups are scared to build on OpenAI's API, which is a classic strategic dilemma.
This is the infamous pull a Microsoft scenario, the Lotus 1-2-3 analogy. Microsoft let application developers build ecosystems on Windows, only to eventually launch competing products that crushed their partners.
And startups fear OpenAI will do the same thing, that they'll eventually launch competing application layer products, rendering their API partners obsolete and turning them into mere data feeders.
And this fear, which is deeply ingrained in the developer community, creates a massive strategic advantage for their competitor, Anthropic.
Right.
Anthropic is positioning its Claude offering as the neutral, developer-first platform. They promise not to compete in the application layer.
So for large enterprise customers who are deeply concerned about supplier lock-in and having their mission-critical application layer compromised by their foundational model provider,
Anthropic becomes the safer, more stable, long-term bet, despite OpenAI's current consumer market dominance. The real AI war is being fought over trust and platform neutrality.
Okay, finally, let's tie this all back to the geopolitical race, which serves as the ultimate justification for all this rapid spending. Jensen Huang, the Nvidia CEO, issued a stark warning.
A very stark one. He said China is going to win the AI race, citing U.S. regulatory hurdles and power constraints.
He's focused on the 50-state patchwork risk.
Exactly. If states like California and New York implement chaotic, innovation-stifling state-level AI regulations like New York's bias audit requirements or California's potential algorithmic impact assessment rules, these blue state standards, designed to prevent algorithmic discrimination or mandate transparency, could become the de facto national standard, regardless of where the servers sit.
And these non-technical regulations specifically throttle the speed of scaling. They require endless compliance audits and state-by-state certifications, which just slows down deployment velocity.
The velocity you critically need to win the race against China.
Precisely.
And so analysts are urgently advocating for a single federal framework, potentially using the Commerce Clause authority to preempt this state-level ideological capture. Otherwise, the U.S. risks inflicting a significant, self-imposed regulatory wound that undermines the $1 trillion of hardware investment and justifies Huang's warning that China, with its unified national strategy, could win the AI race simply by moving faster.
We've covered a remarkable amount of ground today, moving past the headlines and into the actual financial signals powering the AI market. We've seen clear net selling from CEOs, massive strategic exits from whales like Peter Thiel,
and a powerful, diversified, bullish countersignal from Warren Buffett favoring substance over pure hype.
The core takeaway is undeniable, isn't it? The easy, momentum-driven money has probably been made.
Yeah.
The market's in a difficult transition phase.
It is. A phase where investors are stopping paying for illusion, that utopian promise, and starting to demand integration, auditable cash flow conversion on a realistic, multi-year timeline.
So the key question now for any capital allocator is discipline. Are you paying scarcity premiums for superintelligence that hasn't materialized yet? Or are you accumulating integrative beneficiaries firms whose margins thicken as AI diffuses into specific, measurable workflows?
The divergence between colossal infrastructure spending and measured enterprise realization confirms that profits were pulled forward in price, but they have not yet arrived in cash.
And that leads us to the final provocative thought that you need to mull over as you track these insider signals. If the market is indeed priced for perfection, and the biggest risk factor is simply time,
that 5 to 15-year lag until mass productivity truly arrives.
What happens when the next Nvidia chip generation hits its 3-year obsolescence window and the entire structure needs to be refreshed?
That $1 trillion in upfront capex demands its $500 billion in annual revenue by 2030.
So if adoption timelines disappoint, and that inflection point gets pushed out just 2 or 3 years, let alone 10, will the market show the patience required to underwrite that lag?
Or will it punish the delay with brutal, rapid force? That is the multi-trillion-dollar question governing the next market cycle. Until next time, stay analytical and keep tracking those signals.